You ever wonder what really separates the legendary investors from, well, everyone else? Today, we're going to crack open the mind of a true legend, Howard Marks, by diving into the core lessons from his incredible book, The Most Important Thing. And we're going to start with the big question the book itself asks.
Right off the bat, the title itself is a challenge, isn't it? It forces every single one of us, whether you're a total beginner or a seasoned pro, to ask a really fundamental question. So, seriously, what do you think it is? Is it about picking that one magic stock? Or maybe it's all about timing the market perfectly? Or, being a genius with financial models? It really feels like there should be one single, simple answer to this. But here's the brilliant twist Howard Marks hits us with. He basically says, nope. Successful investing isn't about finding one silver bullet. It's about paying close attention to a whole bunch of different things, all at the same time. And if you skip just one of them, the results are probably not going to be what you hoped for. In his book, Marx actually lays out 20 different most important things. Yeah, 20. And that right there, that complexity is exactly why so many of us find investing so intimidating. Okay, so to make this way easier to digest, we've boiled those 20 ideas down into 3 core pillars that really hold up his entire philosophy. If you can get a handle on these 3, you're going to have a much, much stronger framework for making good decisions. Let's get into the first one.
The first pillar is all about your mindset. See, it's not so much about what you invest in, it's about how you think about investing in the first place. Marx has a great name for this. He calls it second-level thinking. It's the total opposite of just looking at the surface of things. Look, first-level thinking is easy. Anyone can do it. But if you want to get better than average results, your thinking has to be deeper and, frankly, better than the crowd's. So let's make this real. A first-level thinker says, hey, this is a fantastic company, let's buy the stock. Makes sense, right? But the second-level thinker, they take a pause. They ask, okay, yeah, it's a great company, but doesn't everybody else already know that? Is all that optimism already reflected in the stock price? What's the upside if everyone's right? And what's the downside if I'm right and they're wrong? You see the difference? It's about finding the things that other people have missed. And here's the bottom line. If you think just like everyone else, you're going to get the exact same results as everyone else. And by definition, that's just average. To actually beat the market, you have to think differently. Your portfolio has to look different. And this is the hard part, your unconventional thinking has to actually be more correct than the consensus. All right, pillar number 2. So once you start working on your own mindset, the next step is to get a read on the psychology of the market itself. And this quote just nails the single biggest trap investors fall into. We see something happening. Prices are going up, or maybe they're going down, and our brains just assume that trend is going to last forever. But Marx is here to remind us, almost everything in the market moves in cycles. Nothing, and I mean nothing, goes in one direction forever. The best way to picture this is a giant pendulum. The market is always swinging back and forth between 2 extremes. On one side, you've got euphoria, where everyone is greedy and thinks they can't lose. And on the other side, you've got depression, where everyone is terrified and selling everything. The key is to remember that the pendulum almost never just sits quietly in that calm, rational middle spot for very long. Just think about a classic bull market. Marx breaks it down into 3 stages. Stage 1, a few smart, forward-thinking people start to believe things are going to get better. Stage 2, most investors start to catch on that, hey, things actually are improving. And then there's stage 3, the most dangerous stage. That's when everybody agrees that things can only go up from here. That moment of maximum optimism, that's usually the point of maximum risk. Okay, let's hit our third and final pillar. This is where the big ideas meet the real world. It's all about learning to play great defense. So, Howard Marks uses this amazing analogy from the world of tennis. The thinking goes like this. In professional tennis, the pros win by hitting amazing, impossible shots that their opponent can't return. It's a winner's game. But amateur tennis? That's totally different. Amateurs win by just not messing up. The victory goes to the player who makes the fewest mistakes. It's a loser's game. And for the vast majority of us, investing is a lot more like amateur tennis. Your long-term success isn't going to come from a few brilliant home runs. It's going to come from consistently and methodically avoiding the big, catastrophic mistakes. As Marx's firm, Oaktree, likes to say, if we avoid the losers, the winners will take care of themselves. So how do you avoid those losers? Well, the single most powerful tool you have is what's called the margin of safety.
This is the absolute foundation of defensive investing. It just means you only buy something when its price is way below what you think it's actually worth. That gap between price and value, that's your buffer. That's your protection for when you make a mistake, or you get unlucky, or the world just goes completely haywire.
Okay, so we've got our 3 pillars. Let's bring them all together and see what this powerful philosophy really looks like in action. When you boil it all down, it's really this. You use that deeper, second-level thinking to see opportunities others miss. With that clear-headed perspective, you can stay calm while the market's emotional pendulum is swinging like crazy. And through all that chaos, you protect your capital by playing defense and demanding a margin of safety on every single investment. You know, what's really freeing about this approach is that it's not about trying to predict the future. Marx is very clear. You can't predict what's going to happen. No one can. But you can prepare. By understanding where we are in a cycle and seeing how people are behaving, you can position your portfolio to handle a whole range of possible outcomes.
And that really leaves us with this final idea. The patterns of the market, the greed and fear, the booms and busts, they never happen in exactly the same way twice. But the human emotions that drive them, they're timeless. They've been the same forever. And learning to recognize that rhythm, that rhyme of history, well, that just might be the most important thing of all.